This podcast was recorded on September 18th, 2024. You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Diana Scott, leader of the U.S. Human Capital Center at the Conference Board, and today's guest host. Today we're going to discuss how businesses are planning their salary budgets for 2025 and which industries will see the highest increases. Joining me is Rita Meyerson, a principal researcher in the Human Capital Center. Welcome, Rita.
Thank you so much for having me today, Diana.
It's a pleasure. So, Rita, before we dig into all the details on this year's salary increase budget, I really want to step back a little bit and let's explain to our listeners about this survey, because I know we've been doing it since 1985. That's a long time. And it's an annual survey. So, what does the survey ask and what do we learn from it, and why do we do this every year?
Okay. So can you believe this coming year will be 40 years that we're doing this survey? And what it does is it serves as a benchmark for compensation teams, C-suites, and boards as they're working through their annual operating plan process. So we field the survey in the end of Q2, early Q3. And we have results that come back, and we like to provide them by Labor Day so that we
How
can...
appropriate.
Yes. Yes. And we like to arm the annual operating planning, which I know you've done lots of in your career. We want to make sure that they have some sort of a benchmark going into, okay, what is it? When we talk about salary increase budgets, it's much wider in scope than just base salaries. So we can consider cost of living increase if you take a pay for performance philosophy, a merit increase. It also may include promotions, equity, internal equity increases, market pressure, hot skills, role changes, those types of things. So that's your base salary. And we also look at non-base salary components. We look across industry, and we look at other elements that might be impacting the salary increase budgets. We work with our labor markets team closely. This year we had 300 compensation leaders participate in the survey. Mm-hmm. And it was fielded, as I said, May 20th through June 14th. And this gives us a view to provide to companies of what's projected for 2025. We also, which is really important, we get actuals for 2024. So we're able to look back and see kind of what was projected and where the actuals fell and where they were in line. And we also take a look back over a period of time to see what's happened, so over decades.
Wow. So it's a treasure trove of information. We have almost 40 years of data. Sounds like it's expanded over time. Mm-hmm. And the trending is probably very, very important. And as you said, yes. I agree. I think the ability to compare projections versus actuals tells us a lot as well about how the economy and other factors are impacting people and how they spend their budgets. So that's great. So anyway, but we want to talk about and get to this year's results.
Yes.
So, let's tell me top level, what do this year's results tell us? And kind of read these survey results for me. How should we view them?
Okay, so for 2025, on average, employers reported plan-based salary increases of 3.9%, and that is a slight uptick from actual growth of 3.8% in 2024. And this is following a trend of what we've seen as the highest increases in 2 decades. So the last 4 years, which is a very interesting time during this pandemic.
Exactly. There was a lot going on.
Yes. We still remain strong, and I know we're going to get into it later today, but today was particularly exciting with the Fed's big announcement. So I know we're going to
let's hold on that, because
yes.
I do want to talk about that, but let's just get into some of the details. Because, we talk about what's projected for budgets. We can dig into some of the details. You said the average is 3.9. I know you have a ton of other data, though. So Tell me a little bit about some of the nuances around that, the median versus the mean, and top quartiles, bottom quartiles, things like that.
So when we look at the 75th percentile, that's where we're seeing the largest increases. So that's pretty interesting that we're seeing that at the highest end, and then at the 25th quartile, the 25th percent mark, we are seeing our slowest increases. One thing I wanted to mention, when we're looking at the 25th and the 75th, it's very important for those companies that have salary ranges. Not every organization has that, but this compensation structure, and we do ask about this in our survey. So that's why that's helpful to understand the 25th mark and the 75th percent mark. But what's really interesting about this year's results is that at the 75th mark, so at the highest percent, so if you pay at the average, at the mean, or you pay above at the top of the market is still moving very quickly, and it's strong.
And I know that we're going to get into some of this, but I know that can differ largely by industry. We have some that are moving very rapidly, some that are not. But, it's interesting that you talked about the trend. And I know last year the actuals ended up 3.8. That was a little lower than what they had projected for 2024.
Yes.
And then I think 2023, can you explain that? I think that was even higher. But this has been historically high. But just talk a little bit about that trend line.
It's a really interesting question because of the continued economic uncertainty that we're finding and that we're seeing. We talk about a soft landing, we talk about a possible recession over the past couple of years, and this kind of like frenzied coming out of the pandemic and the use of other types of levers, which I'll get into in a minute from a compensation standpoint. But what we're seeing is that projected increase is high and slightly falling down, not by that much, maybe by 0.2%. But what it's showing is that the base salaries are remaining strong. However, there's some flexibility in cash flow, in just overall, how is your operating plan moving? So I don't think it's such a dramatic change. I think the real message here is that we're remaining high.
Yeah, but I do know that there is differentiation amongst industries. So
yes.
Which ones are the hot industries? Where is it going up the most, and which maybe are pulling back just a little bit?
So we're seeing the highest increases in communication and diversified financial services. So that is no surprise. So that's media, telecom, and all of financial services, not a surprise. Modest declines in consulting services and utilities. And it's interesting because I know that we did we spoke to Bloomberg about this. You did.
Right.
And I think you called it a disruption
Yes.
in the entire consulting industry.
Right. I mean, I think the entire consulting industry is being disrupted right now. So it's no surprise really to see them pulling back on their salaries a bit, or even just taking a whole fresh look at compensation. But the industry is being disrupted tremendously by some of the smaller players that can now come in and disintermediate some of the larger players.
Yep.
So yes, all of these trends actually do make a lot of sense when you sort of think about what's happening from a marketplace across all these various industries. Like you pointed out, I mean, it's no surprise that construction is doing well given all the infrastructure investment that's happening in our country right now.
Yes.
So it makes sense. There's a scarcity of talent. You need to pay more to get the talent that you need in the door.
And with attraction and retention being the highest priority from our C-suite outlook from earlier this year, we know that this really is in line with that. It makes sense. And it also makes sense when we look at our Reimagined workplace data, where we're seeing it's a little bit easier to find talent and to retain talent than it has been you asked about the prior years, but we're still, it's a little easier. It's still tight. It's still tight.
Really
and that's
tight.
why I think we're seeing the base salaries so high.
Yeah, I mean, if I recall from our most recent study, I think it was 55% of human capital leaders said that recruitment is still very challenging for them.
Yes.
I think it was down from a real high of 83%, but that's still over half are saying they're finding challenges recruiting people.
Yes.
And
yes.
how about on the retention side? Weren't there some numbers on the retention side that basically said it's still difficult to retain your talent, and many, as we know, are focused on that.
Yes, in fact,
we're hoarding talent.
Yes, 41% of human capital leaders said they still faced retention issues. I mean, that's almost half of your population. It's still very important. And if you manage that with kind of the ongoing talent scarcity, we still have to focus on competitive compensation. And we can get into a little bit more what we mean beyond base salary.
Right. Let's just put you started mentioning about talent scarcity. That really comes back to sort of what is the economic situation look like for us. We have a lot of job openings right now. Despite some of the pullback, there's still a lot of job openings in the marketplace. How do you think it impacts wages? And what are we forecasting from a wage perspective? What does that look like? And is that driving some of what's happening here in the marketplace as well? Or are wages being driven by what's happening in the marketplace, more importantly?
I think that your latter question is such a good one. And when you think about also the inflation component of this and the impact of that, one of our labor market economists really shared with me that we're not surprised to see the base salaries continue to be at a strong level because we're catching up to inflation and we're still not there. And the workers that are hit hardest by that are frontline workers, are hourly workers. So that's something that it's really interesting that you mentioned that.
Yeah. So, if you had to sum all this up, because I want to get to some of the more interesting issues around the Fed's activities today, but if we want to sum up just overall, give me your top line.
Top line is base salary compensation remains strong with a projection of 3.9%, and this in the last 4 years we're still at the highest marks in the last 2 decades. So that's great news, and we're happy to hear that. And that signals the economy is strong, attraction and retention is a priority, and you need to be laser focused on competitive compensation to retain your talent.
And we'll leave it at that and take a short break now. We'll be right back with more of my conversation with Rita Meyerson in just a minute.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm your host, Diana Scott, leader of the Human Capital Center at the Conference Board, and I'm joined by Rita Meyerson, a principal researcher in the Human Capital Center. So Rita, let's dig more into the industries and the differences across industries. So talk a little bit about what the differences are and what kind of variations you see in the results. And let's then dive into how you make some sense about this, given what happened today with the Fed lowering their interest rates.
Okay, so first is a consistent trend that we're seeing is most industries saw for 2024 are actuals. Most industries saw increases in line with their forecasts.
So let me just pause here.
Yeah.
So even though we know that the actual from last year at 3.8% was slightly lower than the overall projected average, you're saying most industries, it was very consistent.
Mm-hmm.
Okay, mm-hmm. Wow.
Mm-hmm. It's interesting.
Yeah, that's
However,
that means
there's some outliers.
That means there are some outliers.
Yes. There's some outliers. Yes, there's some outliers. So banking, energy, and agriculture, which that's what we group, reported slightly higher actual increases than projected. That's not surprising. And then if I think about the interest rate cut, I suspect we're going to see a little bit more of a similar trend, at least from the banking, from financial services. We might see that similar trend if money is a little bit less expensive than it has been. We might see that possibly in construction and consumer.
Because people will be able to spend more because the money is easier to get. Okay.
Now, another interesting trend, not industry specific, but on the headcount. I think that's important. We talk about this.
Right.
And you made really great sense of this when we talked about this last week. For growing, the larger actual budget growth for 2024 for the actual was the larger the company, the growth was at 3.8%. So that's consistent at the average actual. But on declining headcounts, we saw a smaller actual budget growth of 3.5%. But it's interesting because those are companies that are decreasing their headcount. So when you think about layoffs or reorganization or divestitures, et cetera, large scale change, you're still seeing in 2024 3.5% as a high point for salaries. So competitive salaries are still essential, bottom line.
Even in companies that are shrinking, perhaps. And there's a part, I would surmise that companies that are shrinking, yes, they're shrinking, but if they've right-sized their organizations, they need to really be focused on retaining the talent that now remains and inspiring them to want to continue and see growth opportunities within their own organization.
Yes.
Which would explain why they still have to focus on having a competitive salary given the tight labor market that we have right now.
Yes, and that leads us to such an interesting point, if it's okay for me to bring this in. When we look, what we have seen a big change in is non-base salary levers such as sign-on bonuses and retention bonuses that were used very frequently during the pandemic. So we see this as this kind of fast-paced, moving quickly, throwing money, cash out the door. There's a pullback on that we're seeing for 2025, and that it's shifting to this retention component that you're talking about. So it might be promotion, it might be role change, it could be hot skills and equity also.
So let's talk a little bit about that because you're right. I mean, during the pandemic, people were desperate to keep workers in place, especially if they were frontline workers in some of the essential industries across the country. It was really hard to find workers, so they were throwing money at them just to keep them in place for that moment in time. And now people maybe are taking the long view, is what you're saying to me.
Yes.
And also perhaps differentiating more based on value to the organization and the value and contributions those individuals make, which makes sense because now you're turning to things like performance-based pay actions that recognize the opportunity to develop people.
I love that. And isn't that the dream of all compensation professionals and folks that are focused on that, on the, from an exec comp standpoint, and that philosophy trickling down throughout the organization?
Absolutely. Yes.
So it's a little bit, you can be a little bit more strategic. And that's something that we found in our Reimagined workplace, in our research that was done earlier this year, that just overall the shift of taking a longer view and being a little bit more strategic.
That's great. Talk a little bit more about focus to equity, because that says to me, again, there's perhaps a longer focus, looking out to the future, trying to, we talk about golden handcuffs. We love that term in the past. A little bit of a golden handcuffs, incentives for people to stay and get payouts over a longer period of time. What are the advantages of that, and are we seeing more of that in our research? Is that indicating that's a trend?
Yes, we are seeing, I'm really glad that we're talking about the equity piece. So we are seeing an increase in both recognition and equity compensation across the board. So when we talk about golden handcuffs, traditionally we think about from an executive standpoint. But what we're seeing is shift, and we're seeing this with some of our members and in some of our roundtables that we've done, that this act as owner mindset, so that you're giving your employees at all levels a stake in the organization's success. So there's a couple of things there. That reinforces your values and your culture. So that's great. Second, from a cash flow perspective, it's a little lighter on the balance sheet, and it gives you a little bit more room to plan.
Everybody likes flexibility.
Yes. So, and especially with this continued uncertainty that's in the market, right? So from an economic standpoint, geopolitical, from a number of reasons, having the short-term or long-term incentive pay, because it could be done in both ways, from an equity standpoint, is a great compensation lever. And we are seeing that's something that we've seen a big uptick for 2025, as well as recognition.
So recognition becomes important, not only, but certainly to the employee, but also to the culture of the organization. Talk a little bit more about that.
So
you're a
important.
Culture person.
Yes. Well,
this is your specialty.
Yeah, thank you.
Your passion.
Oh my God. So it's actually, so when we think about recognition, that is such an important way, and one of the few ways to reinforce culture or behavior change. If you have a particular behavior or way that you want your employees to operate, let's say with I'm just thinking about Walmart for the moment, and they really want to have this idea of empathy and bring that into, and compassion, and bring that into the storefront. So if you have your store employees operating with this idea of empathy, compassion, and you have your people leaders and your store managers all operating like that, if you recognize your employees for doing that, you're reinforcing the culture, reinforcing the behavior that you want.
That is such a great point. And I guess my question to you is, does recognition always have to involve cash? Because I think we have some research that says that there are other forms of recognition that have currency and value.
Yes, that is such a good point. And I think it was a roundtable we might have done last week where we know this from our data, that flexibility is something that was the second highest rated after your base salary in terms of giving
being viewed as a total reward.
As a total reward.
So I think it really speaks to how the thinking around total rewards has evolved over time. And frankly, as I look at the, almost 40-year-long history of this particular survey, we have seen a focus from strictly looking at base pay to all these other types of pay actions, and even some non-pay cash compensation type elements that actually are considered now part of a total rewards package. So, even equity compensation, that wasn't even part of the equation 40 years ago when we were looking at these base salary increase budgets.
I think that, if you kind of think about that, even from a 4-decade perspective, this move towards personalization, and that every employee, you kind of have to meet employees where they are, and what's going to work for one is not necessarily going to work for another. Also, you need to think about, we have 4 generations in the workforce.
Absolutely.
And what the boomers want is very different than what our research tells us on what Gen Z wants. And we know that by 2025, 31% of the workforce is going to be made up of Gen Z. And when we come back to this flexibility as currency, that is we're hearing that is so important.
Exactly, especially for that generation.
Yep.
So it sounds like what we're looking for, what our members are looking for, and what organizations are looking for is an opportunity to have many levers to pull, and that it's not one size fits all anymore. Yes, you can have your salary bands, but there's a lot of differentiation possible, and how you put together your packages of what that total compensation, total rewards looks like can be different from one employee to another.
Yes. It also brings up the point that it puts more emphasis, and we know this from our research with our roundtables, the emphasis on leaders. They need to, if they're being given a budget or a pie or a pot for their annual compensation period, they need to be very strategic about how they're using that. and they need to know what's going to motivate one is not necessarily what is going to, or be valued by one is not going to necessarily be valued. So your top performers, you might think it's going to be all one compensation lever, but it is not. So the education of your people leaders are very important as well.
That's really a great point. I want to just play a little bit of devil's advocate on this point of, you know, having multiple levers and differentiation, because there's a lot of conversation around pay equity.
Yep.
And I think there were some questions in our survey about that. So, you know, where does that come in, and how do you ensure that there is an equitable compensation total rewards across your organization, not perceived to be discriminatory or unfair, that there's a fair compensation approach when you know that people are motivated by different things? How do you find that balance?
That is such a good question. And we know the data that the majority of our respondents say that they are focused on equity pay increases. So that would mean the internal equity as well as looking at external market pressures. However, they might not necessarily have a separate budget for it. They'll take it from their general compensation kind of annual pool. What's really interesting, though, and I think we're going to see a rise in this, by the end of 2025, 25 states are going to have full pay transparency. That brings a very interesting mix, and that we know Gen Z, they all talk about compensation.
They have no stigma. There's no stigma associated with talking about your compensation. Yes. So that will certainly put a lot of pressure around, you know, fairness in terms of compensation, and, you know, flexibility to move all these different levers. So before we wrap up, I do want to get back to today's news.
Oh, yes.
So, you know, are there any implications, or how do you put into context the Fed's rate movement today?
I think what I would say is it's the positive news, and it makes our argument stronger that we're seeing compensation increases remain strong, and that the fear of a recession, it seems to have dissipated. But the focus on attraction and retention in this continuous tight labor market is still very much the priority of the C-suite.
Yes. And thank you. I think we'll leave it at that. Just put the dot on the I with that one. Rita Meyerson, thank you so much for joining us today, and thank you to all of our listeners.
Thank you so much for having me.
And thanks for listening to C-Suite Perspectives. I'm Diana Scott, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.